That's closing bell on Wall Street, and now it's market domination overtime. We're giving you full team coverage of all the moves to get you up to speed on the action from today's trade. Yahoo Finance's Jared Blickery and Josh Schaefer joining us here to break down the moves today. Jared, my friend, we'll go over to you for a closer look on today's sector action.
Had a little bit of spurt to the bullish side in the end, but in the end, it was to the downside for the Dow, closing down 171 points, or down almost 0.4%. The NASDAQ, however, managed to climb back into the green, photo finish there, and it was up whopping 15 basis points on the day. S&P 500, a similar amount down, couldn't climb into the green there, and we'll also take a look at the small caps. Those had been leading early on. The Russell 2000, not shown here, was up 1%, but we lost a lot of steam during the Fed presser, and that you can see led to a down close for that small cap index as well. Now here's the 10-year T-note yield, a net up 5 basis points to 4.38%, and the 30-year, it was up 4 basis points to 4.91%. And also taking a look at the U.S. dollar index, according to some sources, this is the biggest jump for the U.S. dollar index on Fed Day in quite some time. You can see it was up almost 1%. It was up even more 2 days ago. So it's actually been a pretty notable week for the U.S. dollar index. We'll get into that in about 30 minutes with you, Josh, here. But I just want to go to our sector action, and we'll check in on some heat maps here. Utilities, communication services, and tech were the only three sectors in the green. And guess what? Utilities and tech, they finished with record closing highs. Not the case with communication services, but we have some pretty substantial losses for a few sectors here. Materials to the downside over 2%, energy down almost 1.5%, real estate, staples, consumer discretionary, and industrials rounding out the bottom row. And taking a look at the NASDAQ 100, a mixed board here, even with the mega caps. NVIDIA up 2.14%. That should be good for another record high there for the chip maker, 33.5% year to date. Netflix also up 1.32%, Broadcom up almost 2%, AstraZeneca up 3.5%, and not a lot of leaders, not a lot of outsized winners to the upside. Looks like Marvell up 7%. To the downside, we got Mondelez down 6%, PanW down about 5%, and a couple, Old Dominion Freight Line down almost 10%. I'm going to close here on the Dow, and we can see, aside from the mega caps, more red than green. Looks like United Health managed to climb into the green, up 2%. JP Morgan up almost 1%, but American Express down over 1.5%, and Chevron down 2%. Josh.
Thank you, Jared. And Josh, what are you looking with the markets as well as Wall Street, of course, now waiting those big tech earnings?
Yeah, Josh, I mean, one of the key stories in this rally, of course, over the last 2.5 years, and even in the last month or so, has been kind of this tech-driven rally, right? So the question being, can these stocks after the bell today, and we think about Meta and Microsoft, sort of continue to support the upward momentum that we've seen in markets? Because we've been talking a lot about sort of the floating higher of the S&P 500 that we've seen over the last 10 days. But if you take a look under the surface at how stocks have been moving off earnings, there have been outside moves above their 5-year averages. So Evercore's Julian Emanuel tracks this pretty closely. And what Emanuel pointed out in a note to clients this morning, he was highlighting that when a company beats on the top and bottom lines, they beat on earnings estimates, they beat on sales estimates, their stock is seeing a one-day rise of 1.6%. That is well above the 5-year average of a 0.8% pop. You flip that the other way and you look at if a company misses on earnings and revenue estimates, meanwhile with the market at an all-time high, that is punishing stocks more than it typically does. So stocks are falling on an average in the S&P 500 5% compared to that 5-year average of 3.2%. So you have seen outsized moves for specific companies the day following earnings. Of course, seeing an outside move in Microsoft or Meta would mean a lot more for the benchmark index when we think about the S&P 500 than it necessarily would if we're talking about some smaller companies. So any big moves that we could see from these companies from a stock perspective could shake what's been a relatively unvolatile month per se for the S&P 500.
All right, Josh, appreciate it. Stocks closing mixed on the day after the Fed's decision to hold rates steady at their July meeting. Here with more, we got Robert Schein, Blanky Schein, Wealth Management Chief Investment Officer. Robert, it's great to see you, especially on set. So let's start with the Fed. What do you make, Robert, of what you saw and heard today?
Not much of anything. Powell is data dependent, right? And that's what he said.
That's been the mantra.
That's what he said. I think there was a little nuance towards a closer look at the labor market. And I think that's where he said that the labor gap is closing, but the rate of change is now slowing. So labor market is cooling. I think that's going to be the story, and that's going to be the cover for the back half of this year for them to actually look to labor market softening, and then they can potentially lower interest rates starting in September.
So you are looking for a cut in the back half?
I think so. Right now, the futures are showing 68% in the September 25 basis point cut.
If they didn't cut, I'm just curious, Robert, how would the market react? Does the market need a cut to keep moving higher?
I think the consumers need a cut.
Yeah.
So I think that's what's really the story.
Consumers,
if you look
small
at corporations,
businesses,
they're making, whether it's tariffs coming their way or they had COVID to figure out supply chain issues. So corporations are stronger now today better than ever, and they can handle what comes at them. The consumers are struggling, I believe. I think that's where, whether it's the credit card debt and you lower the interest rate, that could help out, or across the board, even on mortgages. I think that's
30-year fixed, still, wow.
60% of the time, the 7% handle on a 30-year fix has been, over the course of mortgages. That's not uncommon. It's just most recently, our memory is anchored towards, a 0% interest rate.
Well,
and
if you're locked in
3%,
7 seems rough.
3% mortgage rate. So that's actually what's freezing the U.S. housing market too, because people are sitting on 3% and they're not going anywhere.
We got big tech earnings rolling in. Just curious, big picture, Robert, kind of your take on this earnings season so far.
Yeah, number one is the tech spend going to continue. We saw that from Google. We're going to see that after the bell with a couple of others, big tech names that are going to report. And then tomorrow we want to see what Apple is going to say. What is their AI strategy? Do they have one? What's their roadmap moving forward, and what's their spend and their strategy as it relates to that? And then, by the way, with Apple, what's their innovation cycle? Are we going to see a smaller phone, or So it's going to be company specific. Like today, we want to see the message would be where are they spending, and is that AI spend still continuing to pull through?
Let me ask you a broader question, Robert. I've had strategists on this week who have told me they actually getting, and the word they used was uneasy about the market. And I asked them why, and they said just kind of the move off the April low, the speed of it. No surprise, for example, they were getting a little uneasy about valuation in particular. They were feeling kind of stretched here. Do you share that, or no, you think we grow into that valuation?
Yeah, valuations are stretched a little bit from where we are. We could see, and seasonality is going to play right in, right? The third quarter, we're going to see August, September, and October, markets taking a breather and really just seeing how the tariffs wind through.
And if we saw that breather, Robert, let's say you saw a pullback, let's say you even saw a correction, would you expect, even if we saw that, investors would just jump right back in?
It depends. It's stock specific, sector specific, and moving forward, there's going to be great buying opportunities.
Let's talk about some of those opportunities you see. One is, you were just mentioning Apple.
Yeah.
You see that as an opportunity. Now, clearly there's been some disappointment from investors this year, Robert. You can see it in the stock. Folks have questions about their strategy, their place in the AI market, but it's an opportunity in your opinion.
I really like Apple right now, 14% off of, down 14% year to date. The markets are up 10+% respectively.
It's been rough.
And so we saw this with Amazon 2 years ago, and Amazon went through a consolidation period. But they have scalability. As an example, with Apple specifically, they have 2 billion iOS devices with
That's a lot of loyal locked-in
All
fans.
they have to do, and by the way, I don't know if you saw this, but they just soft launched and announced Apple One Care, basically. So if you have your devices, I looked at it, and you could add on more insurance for $5.99 a month. For all your devices that the insurance has expired. So we've got a lot of kids in our household, a lot of devices. They just got another $1,000 a year from me. You go across the board and immediately they're picking up revenue hand over fist that's going to be accretive moving forward, just in little spaces like that.
Another name, we were talking about the housing market earlier, D.R. Horton. Why is that a pick?
Yeah, so D.R. Horton is basically the best house in the housing, market, if you will, as it relates to, it's the largest home builder in the United States. We believe interest rates are going to come down. As they come down, it's going to unlock and unfreeze the real estate market. And D.R. Horton has the ability to capture and continue just to be a leader in that category. Again, it's a category that's down year to date, but I think the housing is still going to continue. And the reason why is we're 3.8 million homes undersupplied in the United States. That's a 10-year burn off on a supply-demand equilibrium. You get interest rates kicking in, D.R. Horton's in the right spot for that.
Final question. Let's go from home builders to chips. Talk to me about AMD.
AMD is got pricing power. Most companies don't. With their latest M1 350 chip, They went from $9,000 or $15,000 a chip to $25,000 a chip because the demand is so great. And they're a NVIDIA competitor right now, and they're proving that they can do just as that.
Robert, great to have you on your set. Appreciate your time, those picks, sir. Thank you.
Thank you.
All right, time to take a look at Meta's second quarter results. Yahoo Finance's Josh Schaefer joins us here with the numbers. Josh, look at that move in the price.
Yeah, Josh, you're seeing a big move in Meta there. Shares up almost 9%. So I want to just hit the high-level numbers here for you first. So in that second quarter, Meta reporting adjusted earnings per share of $7.14. That was against a street estimate of $5.89, so a pretty significant beat there. Meta also reporting revenue of $47.62 billion. That was above a street estimate of $44.83 billion. Then you move over to Meta's Q3 guidance. That also coming in better than expected, at least up from a sales perspective. Meta guiding for a range of $47.5 billion to $50.5 billion. Street estimate was looking for 46.2. Of course, Josh, when we talk about a company like Meta and how much they've been spending, CapEx is a key part of this conversation, right? So Meta moving up their CapEx range for the full year to $66 billion to $72 billion. The bottom part of the range had been 64. So yes, boosting that range a little bit, but remember, they had actually boosted their full year CapEx guidance, the entire range, going back to last quarter. So I know some analysts on the street were perhaps worried to the extent that Meta had been spending, and perhaps too big of a move in CapEx would have been downside for this stock. But right now, most of those numbers I read, Josh, significantly better than what the street expected, and you're seeing the stock act like it.
Huge move. We're up more than 9% now in the after hours. I mean, to your point, Josh, we know this company's all in on AI. They have been spending, they've been hiring. You just heard Zuckerberg talking recently. The company's going to spend hundreds of billions of dollars to build data centers around the country. Bulls, of course, to your point, though, they look at all this spend and they believe, and investors seem very optimistic, that there's going to be some long-term meaty ROI on all that spend. It's not just the spending, it's the hiring. We were talking to Dan Howley earlier, how Zuckerberg continues to poach just top AI talent from his rivals, which is, I mean, listen, reportedly the pay packages are incredible, but you also do kind of wonder is it just the pay, or do a lot of folks, are they excited to also just work with Zuck on his AI projects and his AI strategy?
I would think that's going to be a big discussion on the call, right? Is sort of what is exactly going on with a lot of this investment. And Meta did call this out in their release too, Josh. So Meta said they are expecting upward pressure on 2026 total expense growth rate. We expect the second largest driver of that growth to be employee compensation as we add technical talent into priority areas. So they're already getting out in front of it and they're talking about it. They know that this is a big topic of discussion. It feels like over the last month and a half or so, most of the headlines surrounding Meta has been how much they're paying employees to get talent over there and continue building AI. Finally, just to give a quote from CEO Mark Zuckerberg, he's talking about superintelligence, of course, Josh, which I still don't quite understand necessarily at this point.
Just ask Howley.
He's excited to build personal superintelligence for everyone in the world. So we're going to know more about it at some point.
I did see even some well-known bulls heading into this print. Bulls saying they thought that, hey, the valuation is kind of screening expensive here, but look at this one. We're up 9% over here in the after hours. Thank you, Josh. Appreciate it. Let's move on to Microsoft, though. Break those numbers as well. Microsoft, bottom line, I'm seeing a Q4 EPS print of $3.65. I don't see a compare yet on that bottom line. The top line, though, I see Q4 revenue, $76.44 billion. That is a beat. The street was looking for $73.89 billion. Another key metric, Q4 Azure and other cloud revenue, XFX, that is growing, that pops 39%. That is also better than consensus. The street was looking for closer to 34%. Azure's surpassing, it looks like, $75 billion in revenue this year, up 34%. And not surprising, Josh, here's another big tech name. They report, and that stock moving 7% in the after hours.
We were just talking about Meta, Josh, and you mentioned some analysts perhaps being worried about valuation, right? Well, look at Microsoft stock since the bottom. The stock's up 40% since April. Like, we are not seeing a 7% move in Microsoft right now on a stock that has not been significantly rallying. It's essentially trading at an all-time high. So it gives you a sense sort of how much investors like this report. I think that Azure beat, as you pointed out, certainly key. And then I think you tie these two prints together, start to form a little bit of a macro narrative from what we're hearing from two big tech giants here. Continued raising of CapEx guidance, right? Or at least reaffirming of CapEx guidance. They're continuing to invest in AI, and also continued earnings beats. when you think about what has been the key driver of big tech over the course of this rally, it has been, yes, the expectations are always high and they continue to move above that bar, right? And you're seeing that happen once again for what feels like a lot of consecutive quarters in a row now for several of these big tech giants.
To your point, Josh, analysts were quick to emphasize the bar was high here into this print. I mean, the stock had been on a run since that last print. Listen, you're going to more talk about Azure momentum, Copilot adoption. What do the trends look like there? CapEx spending trends. It looks like Q4 CapEx, including leases, 24.2 billion. Street was closer to 23.17 billion. But lots of attention here on AI, on the cloud businesses, and of course, you'll be waiting for the call. That is when you would traditionally hear CFO Amy Hood tell you about the guidance, give color on that forecast.
And then, as Dan Halley has pointed out too, Microsoft has been one of the companies that's early in their release and in the call to really sort of line item where AI is impacting their business. AI is contributing X amount % growth to Azure. AI is contributing X amount % growth to another part of the business. Maybe it's Copilot. And so how they're able to lay out those numbers usually talks well to the street and talks well to investors. So as we think about what's coming in the call and sort of things to watch, I'll be looking at that.
Josh, thank you. Appreciate it. Coming up, putting Meta and Microsoft's earnings into deeper perspective. We're talking to tech sector experts. Stick with us. Well, Meta and Microsoft surging after reporting their latest quarterly results. And join us now to take a closer look at the Mag 7 names. Let's get to D.A. Davidson Managing Director Gil Luria. Gil, it is great to see you. So big tech reports and making big moves here in the after hours. Gil, I know you cover both these names. I know, Gil, you like both these names. Let's start with Meta. This stock is up now 10% in the after hours. What do you make of the results, Gil? Is that move justified in your opinion?
Yes. Yeah, the results, the stock moves make sense. The results are that good, both for Meta, and we'll talk about it in a second, for Microsoft. For Meta, they were able to grow revenue 22%. That's a significant acceleration from last quarter. And the context is Google grew its ad business closer to 12%. So Meta is gaining significant share in the digital advertising market. They're doing it with while keeping, at least to date, expenses under control, and therefore investors have patience for the CapEx guidance that they're providing. For this year, it's only a slight increase, but there was a comment in there about a significant increase in CapEx again into 2026. Investors will have patience for that. As long as revenue is growing this fast, they're selling a lot more ads and they're selling them for a lot more.
So they're spending, Gil, but is your point, listen, we're seeing the ROI on that spend?
To some extent. It's more that investors with Meta have always had patience for the longer term investments when the current business is doing well. When the digital advertising business that is the lifeblood of Meta is doing well, investors have patience for Reality Labs, for Metasphere, and now for these longer term superintelligence investments. That's what's happening, which is to say, the AI investments do pay off in the core business. This is how we sell more ads and we sell them for more, is by being very good at AI, by being very good at developing the right feed and serving the right ads and then being able to monetize that, which Meta is getting increasingly good at. But the investment is well beyond that. The investment, as you talked about earlier in the hour, is about Mr. Zuckerberg's pursuit of superintelligence, whatever that may end up being.
Let me ask you, Gil, taking a step back, when you think about Meta's role, strategy, competitive advantages in that broader AI market, how would you define those advantages?
Well, so one is they're working towards another platform, the next platform, hence the Meta Ray-Ban glasses and Oakley glasses. They want to have the next platform because they don't like that fee that they have to pay Apple and Android for having their applications on their devices. They want their own device, and AI is a big contributor to that. And then they're also working towards having the dominant AI model. Let's not forget, a year ago, Llama 3 was cutting edge, was state of the art. Llama 4 failed, which is why they have now gone and aggressively invested in talent. So the next iteration of Llama can again be state of the art. so they can again be front of the pack in this pursuit of an omnipotent AI model.
To your point, I mean, Zuckerberg is aggressively poaching successfully top AI talent from rivals. When you think about the risks to this one, Gil, I know you have a buy on this one, but when clients ask you, what are the risks I do need to think about? What do you tell them?
That founder mode is great when things are going well. It's been more challenging owning Meta and before that Facebook when things don't go as well. If the advertising market rolls over because of a weaker consumer, investors may lose patience for Mr. Zuckerberg's aggressive investment. So that's the two sides of the coin are when things are great, you want to have founder mode. When the core business doesn't do as well, you have a little bit less impact as a shareholder.
Let's switch gears here, Gil. Microsoft, another name you cover, another name you like. Also, Gil, we are surging higher here in the after hours. We're up more than 7%. What do you make of those results?
They're even better than it seems. This is a company, one of the largest companies in the world that just grew revenue 17% year over year. Their Azure business grew 39% in the quarter. That's a business that's going to be more than $100 billion this upcoming fiscal year, growing 39%. And it's not just the cloud hosting business and the GPU access business. Those businesses are growing so fast, but they're also drawing with them the rest of Microsoft business. They're growing their consumer business, their enterprise software business by high teens and into the 20% range. This is remarkable growth at this scale. It far exceeded expectations. And unlike Meta, they are doing this with more responsible spending. They are figuring out a way to invest in CapEx, build this new capacity, but they are also finding ways to offload excess capacity in the short term so the CapEx numbers don't get out of control. That's why they're also going to be adding about $200 billion of market cap tomorrow.
On the call, Gil, the conference call, that's when you traditionally expect CFO Amy Hood to provide guidance. What do you think we're going to hear there in terms of a forecast?
So I would expect her to try to tone down expectations so that we don't all raise our numbers by the extent of the beat today, but continue the optimism and continue to talk about how they're meeting demand, and then a more nuanced conversation of CapEx. That's what a lot of investors are going to be listening for, is how much increase in CapEx is there going to be into fiscal 26 in order to continue to support this growth. She has already said that CapEx will grow, and it will grow at less than it grew in the last fiscal year. She's going to refine that guidance for us, and the point to which they're investing in CapEx will tell us how much more efficient their business has become.
Let's say, Gil, you had the chance to ask CEO Satya Nadella a question or two on that call. What would be top of mind for you?
Is the growth in AI going to drive GDP growth of 5 to 10% in the future? I think this is where a lot of the conversation is AI growing exponentially, which again is how we explain Mr. Zuckerberg's investment. Is it going to accelerate growth for Microsoft and all of its customers to a large extent, which again would justify some more investment? Or are we still believe that we're in the current patterns of growth that require more caution on the investment? That's really the big question now, because let's not forget, Microsoft is so big that a lot of their growth depends on how much AI accelerates the growth of the overall economy.
Gil, always good to see you, my friend. Appreciate that instant analysis. Thank you.
Thank you.
Time now for what to watch Thursday, July 31st. Starting off on the earnings front, guess what? It is another big day of earnings, including two more magnificent seven names, Apple and Amazon, both on deck. Apple announced results for the third quarter after the markets closed. Analysts expecting Apple to beat earnings estimates for Q3, driven by customers rushing to buy products ahead of potential price hikes from new tariffs. Amazon releasing second quarter earnings also after the closing bell. Investors will be focusing on how that e-commerce giant is navigating tariff uncertainty. AWS revenue will also be in focus, which came in below analyst estimates in the first quarter. And taking a look at the economy, some fresh inflation data coming in on Thursday with PCE, that's personal consumption expenditures. Economists forecasting both total and core PCE to tick up to 0.3% on a month-over-month basis. And finally, we're going to be getting weekly initial jobless claims numbers. Economists forecasting that number to rise to 223,000, signaling that more people are filing for unemployment benefits, a sign of slight weakening in the labor market. Well, that is going to do it for today's Market Domination Overtime. Thanks so much to Jared Blickery for helping us out with earnings today. On the other side of the break, it's Asking for a Trend. I've got you covered for the next half hour with the latest and greatest market move stories so you can get ahead of the themes affecting your money. Stay tuned.